Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com takes a look at crude prices following the explosions at major Saudi oil processing facilities and other action on the major markets. Market historian Bob Hoye talks about so-called safe havens and answers some listener questions that bring up key points on interest rates and whether the equity markets are in danger of crashing. Author of several books on the economy, including The Money Bubble, John Rubino, discusses oil, geopolitics, gold, pension plans, and whether we face not just a recession, but perhaps a Great Depression. Plus, at the end of the show, we'll have company showcase updates from American Manganese President Larry Reaugh and Aven Resources CEO Jim Pettit. We'll talk to Ross Clark right after this.
Cypress Development Corp is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. Welcome back to the show, Ross.
Always nice to be with you, Jim.
Ross, a week ago, if we would have said we were going to talk about crude, people would have said, why? There's nothing going on. A little different this weekend.
Pretty much what I said.
Yeah.
And what do we got? 25 drones and 2 missiles later, becomes a pretty exciting Monday morning. There you are. You immediately go from no risk premium in the oil market to an $8 rally. You get up to $63. And then the question becomes, can they replace the capacity? And yes, it's thought that can be done sometime now out in October, November. And in the meantime, the U.S. has got a strategic oil reserve and they've got all this fracking capability. So this becomes just a flash in the pan right now. But the price is holding very well around this $58 to $59 range. And the oil stocks, in particular the Canadian ones, had a pretty good run there on Monday, held most of the gains through the bulk of the week. So, it could be that that support area at $52, which we've been looking at, might end up being the seasonal low for the year. Our big model, our 10-year cycle, would suggest that if we get back down close to that 52 or 53 and we see some oversold signals, that it will be time to really load up on the oil stocks.
Well, taking a look at the attack on the Saudi oil production facilities, was this because when oil tankers themselves were either seized or attacked, there wasn't really much change in the oil markets at all, because just one oil tanker isn't going to make a big difference in the world market, but when you cut 5% of the production, it does.
Right. Well, no question about that, and that's why we're sitting here with a $4, $5 premium to what we were at just a week ago. It's different when you're taking off ongoing production rather than just a single bit of the inventory as you would have with a ship. But there's always that question of in terms of the shipments through the Gulf. If those end up having more curtailments, and that could have even a better longer term support level for the oil market. So, I'm still of the viewpoint that this market has got reasonable buoyancy. And we'll see how it unfolds. We had the metals. There's another thing. Precious metals had a knee-jerk reaction on the upside, but gold's sitting right now just above its support at the 1500, 1510 level. Doing a pretty good job of consolidating here. But I think unless there's a new catalyst on the upside, they'll want to be looking more towards the 1450, 1460 area before we see really good buying opportunity. If we get some minor oversolds in the next week or so, maybe it goes back to retest the high. But for now, I think that I'd rather sit back and wait for a better break.
The U.S. Fed dropped interest rates as expected. However, we've heard that there was actually some debate at the Fed about whether that drop was needed or not.
Oh yeah, I mean you've got a mixed bag as far as the Fed governors are concerned right now. So the probability of rate cuts as we move through the end of the year, I mean it's at this point now there might be at most one cut going through until December from the looks of it right now. So and we had that massive run in the bond market this year. Got way overbought, corrected back as you would expect. The 10-year and the long bond futures contracts corrected back to their 20-week moving averages. Got oversold at the end of previous week. Nice little bounce this week, but they probably have a bit more of a sell-off to come here before we see the bottom of the bonds and the top of this short-term rise, at least in terms of interest rates. One of the key items out there from a seasonal perspective, was the fact that, we had a bond high where you'd expect to have it late August into September. But the other one that comes into play here is the equity markets. Typically, you have strength in the week and a half to 2 weeks leading up to a triple witching. So that's the third Friday of each calendar quarter. And as of when you take a look at the September time window, the triple witching there, if we look back over the last 40 years, there's only 7 years where the market from mid-September didn't have a correction into October, November, and take out some support areas. So right now, the modeling here has been for a test of the high, possible breakout, but then looking for a failure from that point. So right now, I think you want to be looking at the lows that we put in this week in the S&P and the Dow as critical support areas, because if the momentum on the upside is lost here, probability is we go right back down to the lows of the summer, and could be more than that.
Ross, thank you so much for chatting with us.
Pleasure to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. If you have any questions for Ross, you can send them to info@howstreet.com. Coming up, Bob Hoye next on This Week in Money.
Always consult your investment professional before making any investment decision.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the 2019 drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. I'm speaking with market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Bob, welcome back to This Week in Money.
Well, here we are, and it's always interesting to look back on the market. It has been an interesting week, and then, of course, you always have the mystery of what's coming next week, next month, and that sort of thing, and we cover it as best we can.
Bob, for people who may be new to you because they only listen to This Week in Money and not to your regular show that we record Friday mornings, Bob and I go through listener questions because our listeners are quality folks, as we found out, and have some really interesting questions for Bob, whose history in the financial markets goes back as far as the financial markets go.
Thanks.
So, Bob, our first question then Bob, I read on Tuesday an article in Zero Hedge entitled Fed Concludes First Repo Auction in a Decade Amid Liquidity Panic. However, the markets rallied into the end of the day on Tuesday, apparently ignoring the Fed's liquidity panic. You've predicted liquidity problems in the fall, and it seems this has just arrived. Is it too short, the equity markets? Also, where do long-term Treasury yields go from here? Take it away, Bob.
Yeah, we've been watching this, Jim. Earlier in the year, you had the sudden discovery of problems in Argentina. And then almost the same time, this would be in the first quarter with Turkey. And then a little later on with India and with China. And the problem is essentially huge leverage employed during the bubble, and then it starts going the other way. And we know that throughout history that when you have financial distress, and they're usually found in outlying exchanges, they eventually come to the world's financial capital, which is New York, and it arrived. That was also on the same day that somebody threw some drone missiles at Saudi Arabia oil production, but it might have been there anyways, but it was a sudden discovery of loss of liquidity. And of course the Fed moved to inject liquidity, and the point was they haven't done this since 2009. So it is an important move. People think, like Diamond, who is head of J.P. Morgan, always says that this is really not too much, but then that's the public man speaking. And then also our question includes what's going to happen to the long Treasury market, or in Canada, the long Canada market. And it had a fabulous bull market, a fabulous rally, and in August it was generating any number of our technical bells and whistles, which we were advising our people. The other part of the action in treasuries was that the bond future can often set a seasonal high in late August. Hey, it doesn't get any better than that. And then kind of another go into late September. So the technicals on the long bond were very, very excited. High readings on all the tools we use, and we haven't seen that since June 2016. So we might as well keep going on this because it led to a number of ideas. And of course, the drive behind the speculation in long treasuries was the concept that treasury yields in the U.S. are going to go down to zero or even minus as they are in Germany. And that's just pulled out of thin air. And of course, that was the story in June of 2016, was that U.S. yields were going to go down like European yields. And our argument then was that the then zero yields in Germany and now minus yields is due to a rigged market. And the U.S. Treasury market is so big and so many players that it can't be rigged the same way. So our view in June of 2016 was that the dynamics of the speculation were registering technical excesses, and that then the market would blow itself out. It did. And then it would also hit the German market, which it did. And we used the same thing this year. And the sell-off has been significant. But it's due for, a little rebound. And, things don't go straight up or straight down forever. So the answer to the long bond issue is that in a financial crisis, it can actually eventually go down in price and up in yield. The rally that we might get over the next few weeks is just kind of a testing of the August high, and in a financial distress it can go down. So I think the flight to quality and safety, the counter move, is all in the markets.
We'll have more with Bob Hoye when This Week in Money returns.
Grand Portage Resources' Herbert Gold Project in southeast Alaska highlights increased gold resource, indicated and inferred, of 860,000 ounces, in excess of 10 grams per ton gold. Expansion drilling is planned on the Herbert Gold property for the summer of 2019. Grand Portage Resources trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're chatting with Bob Hoye. We're continuing our theme of answering listener questions for Bob. Bob, with the Fed injecting about $200 billion by the end of the day when this letter was written into the general collateral market, we may be seeing the liquidity event Bob has talked about in the past. Does Bob believe that liquidity issues which require massive intervention such as this are precursors to solvency issues? And that's from our friend Tony Viega.
Yeah, it's a good question. I think some of these questioners must be subscribers. They sound pretty sophisticated. The idea of providing liquidity into a crisis has been around for a few hundred years. And it was used in 1929 and in 1873 bubble as well, when the Treasury was active. And unfortunately it doesn't work, and it seems to be that the size of the overall credit market is immense. And then there are banks and near banks and shadow banks that are not within the Federal Reserve System. And then there's all kinds of players get leveraged up, borrowing short and lending long. And so what happens is that the market is much bigger than the Fed. And as I like to point out, the margin clerks, when it comes down to it, Jim, they've got the power. And this is why you do have financial crises, and which typically precede a recession. And indeed, the original promoters of the Federal Reserve really believed that having the Federal Reserve as a lender of last resort, that then it would prevent the financial crisis that precedes the recessions, and then you wouldn't have any recessions. And the NBER, which is the official designator of the business cycle, points out that there's been 18 recessions since the Fed was formed in 1913. So the theory is very comfortable, but it doesn't work. And the reason why it doesn't work is that it's not one bank at a time or one financial agent at a time that gets in trouble. It's everybody. So then this is why at a time like this, when the market is changing to a likely contraction, the power shifts to the margin clerks at brokerages and equivalent, loan officers and all that sort of thing at banks. So the whole system flips, and then you go into a contraction. And this is just the first hit to the markets. And I doubt that the Fed can provide enough liquidity to get the bubble going again.
We'll have more with Bob Hoye with yet another listener question right after this.
Aven Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Aven's 23,000 hectares Forrest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avenresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Bob Hoye. Question again from a listener. Bob, assuming a market sell-off in October, can we see a double bottom in the 10-year Treasury yield, or can the yield break even lower when the bubble bursts in the equity markets?
Yeah, we've been talking about long Treasuries, and they're fabulous to trade. And what you had here, as I mentioned a little while ago, the counter trade, you've had the flight to safe havens, which has been, when the stock market started to falter, then the alternative place was gold, to a lesser degree silver, and long treasuries, and they all got, utilities were in on the action as well. So these all became overbought, anticipating a long run of cuts by the Federal Reserve, when actually the Federal Reserve is following the action in the market. The Treasury bills trade all the time, 24 hours a day, and that's a market rate of interest. And then you talk about the Fed rates; those are administered rates, and we've found years ago that at the end of a great speculative move, when the T-bill rate turns down, that leads, or it begins to say that perhaps the boom is over. Well, the Treasury bill rate went up until March, and the 3 months, and it's been coming down ever since. That then forced the Fed to lower its administered rate, and then that really got all the excitement in the stock markets and in the bond markets, but it all became overdone and blew out. But our friend's question is a double bottom in the 10-year Treasury yield. Yeah, now we're talking here about yield. So the yield went down speculatively to late August. And as I said, we were looking at the price, and the technicals got way overbought. And the long treasuries can sell off in here. Not going to be friendly to the markets, to the stock markets. And then also on the low-grade side, this is going to be a disaster, because the interest rates going up at longer maturities is not going to be due to a return of inflation fears. It's going to be the sudden realization that there's so much debt issued in the financial mania that most of it can't be serviced. So then it becomes a long bond avoidance condition, mainly because of the street will start worrying about whether the interest can be paid. So it's typical of a post-bubble deflation, and good question.
Bob, of course, many people with the questions that they've been asking seem to be concerned about a market crash. Is there such a thing as safe havens or safe haven?
Yeah, they got bid up. As I said, utilities, long bonds, gold, silver got bid up because they were not really part of the play last year. Safe haven, very safe, is to own some gold and just forget about looking at the price. It's kind of a quality item. And then in previous post-bubble contractions, low-grade credits just become hopeless. So you want to get out of all attractive yielding stuff, all the high-yield stuff, junk, preferreds, that sort of thing. And cash is safe, but you don't get much of a return out of it. But there you can go into 3 to 4 year bonds, and you get some income. You're in a fairly safe place, and then in 3 or 4 years' time, they mature. So you're going to get hit too badly on any changes in the market for bonds. So the safe havens got overbought this summer. And the safe havens in the future would be gold, cash, or, as I said, the 3 to 4 year good grade corporate bonds.
Bob, before we went on air, we were also talking about some of the stories we wanted to do, and you pointed to a headline that said, "Banks warm to mortgage bonds that burned them in 2008. What's behind that?
Amnesia, Jim. And this is what happens in a financial mania. People forget about risk, and they go for high returns. And so you've got banks then competitively, because they all got quarterly earnings reports and stuff like that, so they all get competitive in the markets, and they're buying horrible things, and they haven't bought them since back in 2007, and they're doing it again. And it's fascinating to watch, but hey, it happens. And then you've also got the concept that the Federal Reserve is there to keep the party going. Well, yes, it is there, but there's no evidence that the Federal Reserve can keep a financial party going when it's run its course. And this one has run its course.
Bob, how many times has there been a recession since the Federal Reserve was created with the pretense of preventing recessions and depressions?
Oh, yeah, that one, 18 recessions. And then in my own experience, Jim, in the mid-'60s, I was a trainee in the research department of one of the big investment dealers in Toronto. And that's then when macroeconomists who deal in the big picture, mainly with theories, and they got their hands on mainframe computers. And then they had computer modeling, and this was wonderful. And I remember reading newspaper accounts at the time, and we also had a consulting macroeconomist to address the sales meeting. And because of the wizardry of economic modeling, they were, in the mid-'60s, the word was that the recessions had been eliminated. And they continue. I think there's been 7 since then. And plus you've had a fantastic blowout in commodities in 2008, and then what they called the worst collapse since the 1930s. And then a decade later, you end up with another great financial mania, and it is coming apart. So the theoreticians who came up with central banking, interventionist central banking, haven't studied enough real history, and they don't understand the market. So you've had, even just a few weeks ago, the New York Fed chairman was saying that he was concerned that they didn't have enough price inflation. You know, they've been targeting 2%. Well, all during the 1920s, the Federal Reserve was deliberately easy in credit policies because there was no pricing power. And so they then didn't understand what happens is if you're feeding credit into the market and the public chooses to speculate in financial items, there's nothing they can do about it. And at some point they'll recognize that the theory is wrong. But in the meantime, it's set up very similar to the late 1920s. Federal Reserve worried about not enough pricing power, easing markets, and it's all gone into essentially speculation in stocks and bonds, so of which excesses have been accomplished, and the first crack has happened, and we are in the season where liquidity problems can be discovered. There's nothing we can do about it. There's nothing the Fed can do about it. But I do think that on this contraction that the public is going to look at the trillions of dollars that the Fed spent in trying to prevent bad things. And if you're into recession, I think this time the public's got the ability to say, hey, that theory ain't working, and I'll be watching for it.
Do you think that we put too much trust in these central bodies, semi-government? I mean, they're supposed to be independent, but you know they're as independent as anybody else who can be fired at the whim of some national leader.
But the problem is they're dealing with the wrong theories. But I mentioned the 1873 bubble, and at that time the United States did not have a central bank. It had, sometimes it's called the national banking system, and sometimes it's called the treasury system. But in the summer of 1873, at the height of the mania, one of the key New York newspapers, editorialized that nothing could go wrong. And the reason is because the U.S. did not have a central bank that was on a gold standard. It had the Treasury, which could buy bonds out of the market and inject liquidity, and it was fiat money, so it wasn't constrained by gold. So the editorial was very confident that the Treasury could provide any amount of liquidity. Well, the market crashed, and in England it was a long contraction, and British economists by 1884 looked at how weak everything was and said, oh, this is a Great Depression. So in 1884, they called the contraction that started with the 1873 bubble as the Great Depression. So even then, as late as 1939, senior economists in England were still analyzing the Great Depression, the one that ended in 1895, and reasoning about why it happened and how it could have been prevented. And then all of a sudden they discovered, oh, we have another Great Depression. So, Jim, I hate to say it, but the combination of economists, intellectuals, and market reality is a never-ending source of irony.
China, of course, is looking to people who have been so-called classically trained in finances to look after things in their country, because capitalism in China under this regime or the communist regime is relatively new. Would they be best to ignore these so-called classically trained people and perhaps find out the hard way how the markets really work?
It's going to be a strict lesson. Yeah, the theory that in a severe contraction, just credit just disappears, goes, whoosh, gone. And an early example was the 1618 crash in England, and there was an intellectual then, his name was Edward Misselden, and he looked at the hardship that you get with a hard recession and high unemployment, and it bothered him. So in 1622, he wrote a paper that included the observation that all would be well if there was more credit. So the idea that an agency exists that can make things better like with the move of a wand has been around. And then when I was talking about the 1873 bubble with the U.S. not having a central bank, the street really believed that the Treasury system would be their savior. And then you move ahead to the 1929 bubble when John Moody, the Moody of Moody's, he pointed out that the dreadful previous system was gone, and we now have a new and scientific Federal Reserve system, and nothing can go wrong. And it went wrong big time in 1929, and then moving ahead one more to 2007 when Greg Mankiw, who is an economist at Harvard, in December of 2007, he said that nothing could go wrong because the Federal Reserve had, in his term, a dream team of economists. And then it went wrong big time. So the overall view on this one, Jim, is my own. And the history shows that whenever you're in a bubble, the market, the street will consider that whatever agency exists will keep the bubble going. So to review it just one more time, 1873, it was because the U.S. did not have a central bank. In 1929, it would keep going because the U.S. had a scientific central bank. And then in 2007, it was that the Fed had a dream team of economists. And so now everybody got excited in August because the Fed was going to cut interest rates, and that would keep the bubble going. So sad to see, but it's not working.
We hear there's pressure for the U.S. Fed to drop their rate to zero or lower. Any evidence that zero or negative interest rates actually make a difference or help?
Well, you want to be careful in this one, Jim, because we're talking about short rates with the Fed funds.
Yeah.
Fed funds rates are going to go down to zero again. And the idea that the first Fed cut will keep the market going has been an error. And what you have is that the fastest declines in short rates, such as T-bill rates, with the Federal Reserve following with its administered rate, you get the fastest declines in those rates in the worst parts of a bear market. So the theory has nothing to do with what happens in the real world. And then every once in a while you have the fantastic world, the fabulous world where we have been with this bubble, and suddenly it meets harsh reality. And as we started the show with, Jim, is that this hit to the U.S. money market, and then the Fed providing billions and billions of liquidity is just the first step in a likely contraction possibly to be discovered this fall. And here's step one in the discovery. We don't know when the next step will come, but I think there will be a couple of more serious hits to the markets before this is over.
Bob, always fascinating chatting with you.
I love the history, Jim, and I love to talk about it, particularly at very acute times in the financial markets. And people should just look and make sure they're as safe as possible. Build as much liquidity as you can.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. And as you heard, he does answer listener questions. So if you have any questions for Bob or any of our other guests, you can send them to info@howestreet.com. Coming up, John Rubino next on This Week in Money.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. Welcome back to This Week in Money, John.
Hey, Jim. Good to talk to you again.
A spectacular explosion and fire at the major Saudi oil production facility, a 5% cut in world oil supplies. They didn't waste time hiking gasoline prices, even though North America is awash in its own oil. Do you think the oil companies always take advantage of disasters like this?
Oh, yeah, of course they do. You notice gas prices go up faster than they go down in almost any kind of a situation. But this turned out to be kind of a non-event, didn't it? It looked like, at first, Saudi oil production will be offline for months. And then the very next day, most of it's back online already. So it didn't turn out to be a serious shock for the oil markets. It's more of a geopolitical issue because, instantly everybody said Iran did this. And I don't know how they can possibly know that instantly. So it looks like this may end up being just an excuse for a broader Middle East war. And we got to pray that that's not the case because, my God, the U.S. and Israel and Saudi Arabia on one side and Iran and Russia and China on the other side that's a nightmare scenario in a part of the world that, is always on the verge of some kind of a nightmare scenario. So let's hope that President Trump here in the U.S. continues to be reasonably sane about all this. I never thought I'd be saying that. Thank God for Donald Trump's sanity, but he doesn't seem to be in any hurry to be pulled into a big Middle Eastern war, and let's just hope that remains that way for a while.
Perhaps he fired John Bolton at just the right time.
Oh, yeah. Can you imagine what Bolton would have been advising right now? He'd have been lining up nuclear weapons targets and starting World War III if he could get away with it. So yeah, Trump got rid of him just in time. The interesting thing is why he would have hired somebody like that in the first place, who has instincts that are so at odds with his, because Trump is, in most ways kind of an isolationist. He's not a globalist. He's definitely not warlike. His first impulse is not to just bomb the hell out of somebody. So I got to say, I was never a big Trump fan, but I'm appreciating him right this minute.
Well, perhaps it's the real estate agent in him. He doesn't like to destroy property.
Well, yeah, his big deal in the last year was trying to acquire Greenland. And, so you get you hire a real estate guy as your president, and you got to expect real estate deals as being part of the process. And yeah, he's trying to acquire stuff, and he's hesitant to blow things up. And all things considered, I like that approach a lot more than some other potential approaches.
Geopolitics then in the Middle East, how big of a player is that going to be, not just for crude, but for other commodities and just peace of mind when it comes to investing?
Well, it's potentially huge. And hopefully it's nothing, but it's potentially a gigantic issue for the financial markets going forward because, we're easing our way out of fossil fuels. And 20 or 30 years from now, I don't think oil is going to be nearly the big deal in the global financial markets that it is today. But right now it still matters. So leaving all the other crazy stuff that would result possibly from a war in the Middle East, just looking at a supply disruption in the petroleum markets, that takes us kind of back to the 1970s, doesn't it, where we had lines at gas stations and raging inflation in a lot of places and financial instability and a collapsing dollar, and all of that stuff is possible again if we have something happen that spikes the price of oil up above $100 again. So we really don't want that to happen from the point of view of stable financial markets and the point of view of, your and my stock portfolios, assuming that we own any regular equities. If you own the S&P 500, the last thing you want is a gigantic energy crisis. And, we're really close to that right now because it's not clear that we're done with all this yet. Trump decided not to immediately bomb Iran in response for this attack in Saudi Arabia. But that doesn't mean that we're done with the process of investigating and coming to conclusions and then responding. So that this could still bubble up, could still blow up on us, and we just have to hope that it doesn't, that they find ways to do a deal that keeps the U.S. and Iran away from the nuclear weapons button, because Iran is developing nuclear weapons right now, and we don't know how far along they are, because that's not the kind of thing you announce until you are so far along that nobody can do anything about it. But the weaponry that's available to the players in the Middle East is becoming exponentially more powerful.
Well, isn't the big danger, too, with them, they're working on their own weapons, but what's to stop them from borrowing a couple from Russia or China?
Yeah, or North Korea.
Yeah.
There are nuclear weapons, and there's nuclear material out there floating around. So even if you don't have an ICBM with a high-tech H-bomb on it, you can still make a dirty bomb pretty easily. You set something off in the middle of a major city, and it irradiates a big chunk of that city for the next 1,000 years. That's technologically available to an awful lot of players out there, and including, no doubt, Iran. And then there's the cyber war aspect of all this. You've got a lot of high-powered hackers involved in this mix right now who can shut down power grids and crash banking systems, among other things. And all of that is on the table, too. We've got a lot of weapons that we didn't have in previous Middle Eastern crises or any crisis anywhere. And it's not clear how those things interact once they start being used. And again, we just have to hope we don't find out. These are questions that we really don't want to have answered. And we're very close to answering those questions, and it's going to be really bad. So, from a personal investing standpoint, okay, which is really the purpose of most of my work, is, how do you structure your own finances in a world that's this crazy? And the answer is you be very careful. You don't load up on growth stocks, even though they might go up from here. In a lot of scenarios, the risks inherent in volatile financial assets are rising exponentially as geopolitics becomes more and more unsettled. So you don't want to take big chances with your money in a world that may not cooperate, that might not stay stable and placid and forward-looking for very much longer, which means you want to shift into real assets that have utility beyond their fluctuations in the financial markets. So, if you own a good rental house, for instance, that's something that's reasonably well sheltered from the craziness of the world. Gold and silver held in a safe place, either, right on hand or stored in a place that you trust, offsite. Those things tend to do well in situations like this. And, energy assets, although I'm hesitant to say, buy something that will go up if there's a Middle Eastern war, and then maybe you'll be happy about the Middle Eastern war. That's a kind of ambivalence that causes people a lot of trouble. And so you buy yourself some financial stability by betting big on energy in the face of a possible energy sector war. But you end up profiting from other people's misfortune. And it's not that easy for most people to sleep in a circumstance like that. So I don't know. There isn't a really long list of things that you can be in. And, cash right now. I don't normally think that fiat currency cash is a great thing to be in. But there are times when liquidity becomes all important. And so dollar cash is not a bad thing to own in a situation like this. And then cryptos, which I think most people still don't know how to buy and store and transact with cryptos. But Bitcoin would probably do pretty well in the worst case scenario that we're talking about here too. So it wouldn't be a bad idea to have some exposure to some of the bigger, more stable cryptocurrencies.
We'll have more with John Rubino right after the break.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with John Rubino. John, interest rates. The Fed did lower its rate, but something I found really interesting is Denmark, as we did this interview, raised their interest rates for the fourth time this year. Why would little Denmark be doing something like that when the rest of the world seems to be lowering interest rates?
Well, their rates got extremely low extremely fast. I think Denmark is where they had negative interest rate mortgages until very recently, or they may still, I don't know. But, maybe they thought they reached the point where they found that elusive, effective lower bound for interest rates. In other words, they lowered rates to the point where the problems became bigger than the solution. And they decided that they wanted to kind of recoil a bit from that point and try to get rates up a little bit. I don't know. But they are bucking the trend for the whole world. Nobody else is raising interest rates right now. Everybody else is either stable at extremely low levels or they're cutting interest rates, like in the case of the U.S., to get more in line with the rest of the world. And that trend looks likely to continue because the global economy is not behaving very well, even with interest rates at historically low levels. From a Keynesian economic standpoint, rates at this level, money this cheap, should be igniting a rip-roaring boom all over the world. We should all be borrowing like crazy in order to buy frivolous stuff with all this free money that people are giving us, and it's not happening. And the fact that it's not happening implies that all the debts we've taken on in the past have become so onerous, and they're slowing us down and smothering economic activity in such a way that interest rates have to go even lower before, we may never get a borrowing boom again. But in order to find out if it's possible to generate a new big burst of borrowing and another big upcycle in financial asset prices, it looks like we have to lower interest rates even further. So everybody has started to expect lower interest rates. And that becomes kind of self-defeating, because you don't borrow now if you think rates are going to be lower later. My wife and I are going through exactly this kind of thing. We sold our house a while ago at the peak of the bubble, at least what we thought was the peak of the bubble. And now we're wondering what to do next. But part of the thinking that we're going through is that if mortgage rates are going to go down from here, then it makes sense to wait for a year or two. And if, housing prices have peaked, which we think they have, then that also makes sense to wait. So the fact that interest rates are falling is actually contractionary, because people are waiting for them to fall even further before they borrow. And boy, if that's the case across the board, then central banks' hands are kind of tied, right? Because they have no choice but to cut rates, but the act of cutting rates convinces people that rates are going to go down even further and causes them to borrow even less. We might be in that kind of a situation, and if we are, there really isn't any obvious solution. And we're stuck with all this debt that we took on in the past that we really can't manage without lower interest rates. But we're hesitant to do the things with lower interest rates that would help us manage our debt, because we think rates are going even lower. What do you do then? Central banks don't have any tools for managing a situation like that. And maybe we just drop back into a Great Depression. We'll have to see. It's difficult to make that kind of a prediction, because that's a really big thing. It's kind of a one-time in a generation thing, and there's no way to know the timing of it. But we're creating the conditions in which something like that has become at least conceivable. We can see the mechanism through which something like that would happen, and that's very scary. Again, it takes us back to financial market instability. Even if geopolitics doesn't do it, the crazy fixed income market now, where we're taking on, insane amounts of debt that we can't handle, and we don't know what to do about it, and we may not have any tools to fix it. That should also lead you into real assets, and not reluctantly either. You should be jumping with both feet if that scenario is really playing out, into things that when governments do decide just to devalue their currencies on a really epic scale, it doesn't make your financial assets become less valuable. Your real assets will go up in that kind of a situation.
Draghi, in his last act as the boss of the European Central Bank, said pension funds are really taking a hammering because they don't have positive growth, and then he made the interest rates in Europe even lower. I mean...
Yeah. Well, it's the old saying that if your only tool is a hammer, then every problem looks like a nail. And for central bankers, all they've got is easier money. That's their only tool. So Draghi, in his farewell speech, basically said, yeah, we're going to give you easier money for as far as the eye can see, in one form or another. We'll do a bigger QE program, or we'll cut interest rates even further, or we'll do some new thing that we haven't unveiled yet. But it's all going to be about making money easier and easier going forward. And, it is interesting that he started with the problems that extra low interest rates are causing for big sectors of the financial community. Because really, think about it, if you're a pension fund manager, you've got an 8%, or realistically a 7% return target going forward in order to keep your pension fund from being so underfunded that it just kind of blows up on you. You got to generate 7% returns going forward. And bonds are yielding 1% or 0.5% or negative 0.5%. How do you do that with the fixed income part of your portfolio? One way to deal with that is to jump into equities, which in good times at least, have higher returns, but in bad times they have big negative returns. So you don't want to do that if you can help it, because you know that there is a stock market, or not collapse necessarily, but a bear market out there coming when stocks drop by 20%. And if the part of your portfolio that you're counting on to give you extra returns actually drops by 20%, as a pension fund manager, you're basically done. You're toast. and these pension funds are crucial to the financial stability of the developed world, because that's where retiree incomes come from. And retirees, if they don't get their pension payments as promised, don't spend money. And if, the ever-growing group of people out there that are over 65 and are living off pensions don't spend any money, then the economy starts to contract. And then you're right back in the whole next Great Depression kind of scenario where there's nothing you can do about anything, and you just start tipping into a deflationary crash. And the pension funds could be one of the catalysts for that. And central banks are aware of it, but they don't know what to do about it. They have no solution. And one thing they're going to try, though, Jim, is buying equities in the future. They're going to try to guarantee increasing equity prices as a way of stabilizing the economy and getting people spending and bailing the pension funds out of the problems that they're now in. And that's a new thing. When major central banks start buying equities really aggressively, that's kind of like a leveraged buyout of the private sector by the public sector. And that means capitalism kind of ceases to function. In other words, prices don't signal anything to entrepreneurs about how to allocate their capital anymore. And, it's not clear what that means, except that we do have some historical precedents, like Europe in the 1970s, where they nationalized everything in sight and descended into chaos. Or, of course, the Soviet Union, where the government owned all the means of production, and they descended into chaos. So it looks like the common theme is that if we try to buy equities via central banks in order to prop up the financial system, we get chaos. The system will spin out of control. And unfortunately, it looks like that's something that we're probably going to try, just because we don't have any other solutions. They have nothing else to do with their easy money, because the interest rates are already pretty close to as low as they can go. And they've already bought most of the high-grade bonds that are available for them to buy with newly created currency. So the next asset class in line is equities, followed by real estate. And once you get the government buying up all the stocks and a big chunk of the real estate in your economy, it's kind of game over for the whole concept of capitalism, right?
Well, the Bank of Japan is already buying up every ETF they can find. They will be the major shareholder in the country's 50 largest businesses. So it's happening there. And if it's such a good idea, why isn't the Japanese economy booming?
Well, you're right. Japan is leading the way in this. And with Switzerland not too far behind, interestingly. But you're right. It has not resulted in renewed growth or renewed risk-taking on the part of big businesses or anything, which is what you hope for when you ease monetarily. So if it didn't work in Japan, it's not likely to work the way Keynesians hope it will in the other countries who are going to try it. And, we're going to end up with a world where the governments own the private sector if we go that route. And it doesn't look like there are a lot of a lot of alternatives. They're going to have to do that or something like it as the next stage of monetary easing when the next recession hits, because they won't be able to push interest rates down a whole lot more. Although I think the process is going to be interesting because they will push interest rates down, but there's a term called the effective lower bound that economists use to point to this kind of hypothetical interest rate that is so low that it kind of blows up the financial system. In other words, the cure becomes worse than the disease, and the unintended consequences become overwhelming relative to whatever benefits that you get from it. And so we're headed for that. And that's going to be the limiting factor in lowering interest rates. I mean, we found out that a negative 0.5% interest rate does not blow up the economy in Germany or Japan, at least. And the U.S. will have to do something like that in the next recession, because normally in recessions, the Fed here in the U.S. cuts interest rates by about 5 percentage points. In other words, from 7% on the Fed funds rate to 2%, or from 5% to 0%. But if we're already at 2%, and the next recession hits, then we've got to go to negative 3%. And that might be the effective lower bound. In other words, that might be the number that blows up the economy. And we don't know what it's going to be. We don't know what the number is. But the further down we go, the closer we get to that number, by definition, right? You know, if it's out there and we head in the direction of it, then we get closer to it. And if it turns out to be 2.5%, and we try to go to 3%, negative 3%, then what does that mean? Nobody knows. See, that's the thing, Jim. We don't know what happens when we reach the effective lower bound in terms of interest rates. So central banks will probably try not quite to hit that effective lower bound, and they'll probably try to buy up other asset classes when they feel like they might be getting close to a negative interest rate that's actually dangerous. I would argue that any negative interest rate is dangerous in the long run. And maybe it doesn't blow things up in the short run, but it so distorts the price signaling mechanism of financial markets that you end up with a growing mountain of malinvestment. In other words, people buying things and investing in things that they shouldn't have bought or shouldn't have invested in, and that don't generate enough cash flow to pay off the related debt, and that therefore lead to the bankruptcy of the people doing the buying and investing, you know, and you get that on a big enough scale, and there's your Great Depression. You know, that's one way to get there. And we're headed that way via extremely low interest rates, because now if you're an entrepreneur or a big company, you have no idea where you should be investing, because the cost of capital doesn't tell you anything about how to allocate your money. So you make mistakes because you don't have good information. And we're headed that way. You know, we're going to see the results of that in the future, even if we don't cut interest rates from here. If we stay exactly the way we are, we still have a gigantic crisis from corporate malinvestment out there looming. So everywhere you look, there's some kind of a catalyst for some kind of a big crisis. And the governments of the world have very few tools left to deal with it. So the next decade, Jim, is just going to be fascinating from an economic nerd standpoint. You know, I'm not saying I'm looking forward to it, because I'm really not, but I'm fascinated by the process and I'm finding it really interesting. But for the average person who doesn't obsess about stuff like this, it's going to be incomprehensible and terrifying and painful. And those are the people who don't deserve to be hurt by this, because they didn't cause it. They didn't understand it while it was happening, but they're going to be the ones who suffer, and it's really a shame. And I wish there was some way to prevent that suffering, but there really isn't. It's coming no matter what we do now.
Don't we effectively have negative interest rates in our banks right now, where they charge you exorbitant service fees, and those service fees are always going up? If you put $100 in the bank right now, guaranteed by the end of the year, all that money is gone.
Yeah, that's effectively a negative interest rate. If the fees exceed the income from the account, then your capital shrinks over time, and that's the definition of a negative interest rate. So yeah, that's a thing now. You know, if you've got a savings account that's paying you 0.2% and the fees are 0.5% per year, then your savings shrink. And think about that. Savings by definition are where you put your money now that you don't need now, so you can use it later. And in all of human history, you got paid for that by giving somebody else money for a while that they can then use to generate income. They were forced to pay you something in order to get you to do that. That was interest. And now it's the opposite. You have to pay them in a negative interest rate world. You have to pay them to take your money. And, that's philosophically and intuitively absolutely crazy. But it's also financially really debilitating, because when savings shrink, you can't, by definition, have a growing economy where people have growing savings to spend in the future and generate growth, right? The growth you generate when capital is shrinking has to, by definition, be negative. In other words, the economy has to shrink if everybody's savings are shrinking. And that's the world we've created. And again, we don't know how this is going to play out exactly, because we've never tried this before. It's one of those crazy experiments that that intuitively don't make any sense. Therefore, nobody's bothered to try it because they assumed it would work out really badly. But now we're in a situation that's so boxed in, so scary, and with so few options, that we're going to try this, or we are trying it. But here in the U.S., we're going to try it. I think that's one of the big phase changes that you're seeing taking place in the financial markets right now, is people in the U.S. are now accepting that we might have negative interest rates pretty soon. And that's, for instance, leading gold to go up here. You know, gold is at record levels in a lot of other countries. Is it in Canada now, Jim?
Yes, it is.
Record? It's a record high in Canada.
Yeah.
Okay. And in the U.S., gold has still been kind of weak, but it's starting to go up now, and that coincides with the change in thinking among Americans that maybe we are going to have negative interest rates after all. And so we shouldn't be surprised that gold is going up as people figure out that interest rates are going to go down into negative territory here, just like in the rest of the world. So here, the financial markets are starting to behave like they have been behaving in other parts of the world, with people buying precious metals as as insurance against the instability that might take place if interest rates go to negative territory, and because the cash flow advantage of bonds is being eliminated now. It used to be that, you know, if you bought gold and stored it somewhere, you had to pay 1% a year to store it. And meanwhile, Treasury bonds were yielding 6%. That was a huge advantage for Treasury bonds because their cash flow was 7 percentage points higher than gold's. Now, with Treasury bonds heading for zero and maybe going negative, that eliminates the cash flow advantage of fixed income assets over precious metals. And since precious metals have over time gone up pretty consistently versus fiat currencies, people are looking at those two things and thinking, well, let me have the thing that, if they each yield negative 1% a year, let me have the thing that's going up in value. And I won't bother with the thing like Treasury bonds that don't go up in value. So more money is flowing into precious metals. There's no reason to expect that to end anytime soon, because we're making even bigger mistakes in the same direction. If we're going to keep pushing interest rates down, if we're going to keep borrowing more and more money, the U.S. is now running deficits. The U.S. federal government is running deficits that are pretty close to the post-2008, 2009 deficits that we ran when we were in existential crisis. We were borrowing insane amounts of money because the alternative might be a collapse into another Great Depression back then. And now, we've had 10 years of expansion, and we're running trillion-dollar deficits still. We're making mistakes that are going to be seen as incomprehensible by historians when they sit down to sort all this stuff out. And we're not even doing anything to try to deal with these mistakes. We're not trying to stop. We're actually accelerating the amount of money that we borrow pretty much at every level of every major entity in the U.S. Corporate bonds are rising at record levels. Consumers are borrowing a lot more money again. Student loans are still going up. The federal government, of course, is running massive deficits. So no sector of the economy seems to recognize that taking on ever larger amounts of debt 10 years into an expansion is kind of a bad idea. And so at some point the economy will turn down, just because it always does. There's a business cycle. that requires recessions every 6 years or so, really, in the past. And we're 10 years into an expansion now. So at some point we get a slowdown. And at some point that slowdown turns into, a recession, which is basically just 2 quarters of negative growth. But debt usually expands dramatically in recessions because the governments are borrowing aggressively in order to lean against the downturn. So they cut interest rates and they borrow a huge amount of money and spend it. And in that way, they hope to pull us out of the recession. But since we're already borrowing such huge amounts of money now, the amount of money that we're going to have to borrow during a recession is going to be immense. It's going to be unprecedented in every major government. Not all of them are going to borrow money that will be on a scale that we've never seen before. So if we think the numbers are crazy now, wait 2 years to the bottom of the next recession and look at what we're doing, because it's just going to be so off the charts that if it doesn't freak out the financial markets, then the financial markets are brain dead.
John, we haven't talked about Brexit yet, but what's that going to do to the British and European economies, or is it such a big unknown we just have to wait and see if it's a train wreck or a plane crash?
Yeah, I don't think anybody has any idea still to this day what's happening with Brexit, because it turns out that the UK and the EU were so legally and regulatorily intertwined that separating all those connections in a way that's not chaotic is looking kind of impossible. But they've got some deadlines now. Britain has a new prime minister whose total mandate was to get Brexit done, and the latest deadline is approaching. So it's completely possible that they end up with what's called a no-deal Brexit, where they just say, okay, that's it. We're just not part of this organization anymore. And then they have to sort out all this stuff that they wanted to sort out ahead of time. But now they're going to have to do it through the courts and through the regulatory bodies of the UK and the EU. And that looks, to call that messy is understating the case so completely that the word doesn't even apply. At least in theory. I mean, we really don't know how this is going to go. It may be just smooth as silk, no problem at all. But it's not looking like that right now. And that's as Europe wants it, because they don't want it to be easy to leave the European Union, because if Britain were to leave the EU and then 2 years later be great, just really enjoying life because they're trading more with the rest of the world and their economy is growing, how long do you think Italy's going to stick around, or Spain or Portugal or Greece? They'll all follow Britain out of the EU. And that's the last thing the EU wants, because that would crash the euro and make trillions of dollars of bonds that are now denominated in euros hard to figure out at the minimum, if not send them into default. So they don't want that to happen. So it's in their interest to make it really hard for Britain to leave. And we're seeing that play out now. So it's possible that, I think the EU's best case scenario is that Britain just leaves and it's chaos for 2 or 3 years, where they, that nobody can figure out what the rules are that apply to any kind of cross-border investment, and stocks and bonds tank, and a huge recession ensues. And see, that tells Italy, you can't leave. We got you now, because look what happened to Britain. So who knows? I have absolutely no idea how this is going to play out, but it's really interesting on a lot of levels. And the major level is that the EU and the euro were big experiments in which a bunch of different countries who perceived themselves to be too small to be viable players in a global economy decided to band together and create basically a United States of Europe that was one big country that would be consequential and powerful and successful. And it's turning out to be a lot harder than they thought on a lot of different levels, because, for instance, a monetary system that suits Germany emphatically does not suit Italy, right? You really can't have those two cultures existing in the same system without one of them feeling really let down, and really disadvantaged and really put upon by all these rules that really don't apply to their culture or shouldn't have to apply to their culture. And that's what's happening now. And it's not working. So, even taking the UK out of the equation, the EU and the Eurozone face existential threats in the not too distant future, in which the less efficient countries like Italy and Spain, et cetera, really just can't function with a euro that's strong enough to suit Germany. And they're just going to drift further and further into crisis because they're borrowing huge amounts of money. They change governments every 3 weeks, it seems like, and nobody can fix their problems because they're just basically a profligate society. I'm, speaking directly about Italy right now, but the other ones, on the periphery of the Eurozone, have basically the same problems, just not as severe at the moment. But there's no way for these guys to continue to borrow huge amounts of money without it blowing up on them at some point. Because in the past, Italy used to do this. They lived their life on borrowed money, and then they would just devalue the lira every once in a while, and then life would go on. And the bondholders would be screwed, but everybody else would basically be okay. Now they can't do that because they don't control the euro. So I think the bigger story of Brexit is that the whole EU may be doomed, and Brexit may just be the first step in this long process of the unraveling of the euro as a reserve currency and of the EU as a big coherent economic entity. And if that's the case, and it's going to come, if it comes, in the next recession when all this other crazy stuff is happening. So the European Central Bank is going to be cutting interest rates and buying up assets everywhere, and some of the Eurozone and EU countries aren't going to be able to function, and they're going to want to leave, and it's just going to be a huge mess that will compound the problems that are going to come inevitably from all the debt we've taken on. So I don't know. The next 10 years might be a good time just to go to the beach and sit there and read, mystery novels and stuff like that and not pay attention to the news and just let all this stuff happen because there's no way to fix it. There's no way to stop it. And it seems to be coming at an accelerating rate.
Do you think that they'll have a united European army? Because isn't Russia kind of eyeing disunity in Europe as a weakness, and perhaps they'd like to take more than just the Crimea?
Well, part of the reason for NATO, or maybe the whole reason for NATO, was Russian expansionism, or the perception of that. But you know what? It doesn't seem like the threat is worthy of the concept of NATO now. Russia it's never been that expansionary. I mean, they want to control the land around their borders as a buffer because they keep getting invaded. Western Europe has invaded Russia, and Russia has never invaded Western Europe except right at the end of World War II when they were just trying to bring their tanks into Germany to finally defeat the Nazis. So Russia wanting stability and a little bit of control around its borders is an understandable thing. I mean, it's not pleasant for the countries that are right there, but it isn't an existential threat to Germany or France or anything. It's just not, there's nothing in Russia's history that implies that would be the case. So I get the idea of a European military, just because they're trying to integrate. They're trying to become the United States of Europe, and that would imply a single military budget and a single military chain of command, right? Instead of France having their military chain of command and Germany having one in Spain, et cetera, et cetera. If you're going to integrate your economy, you need to integrate your military. So that all makes sense. But again, if you can't integrate your economy, then it's really difficult to have an integrated military while your economy is spinning out of control. And, all the different central banks of the different countries are vying for power in their little, it just doesn't work. So I think Russia, ironically, is probably one of the factors that will work to hold the EU together when maybe it should fragment for financial reasons. So it's possible that the drive to create a unified European military will be a stabilizing factor in what's coming in the future. But God, there are so many moving parts to this story that I wouldn't even venture a guess about what does what, and what's good and what's bad going forward, and what's useful and what's not useful. It's just such a huge, gigantic, irredeemable mess that I think it's going to blow up. And I don't think that in the end, today's EU is going to look anything like the EU of 10 years from now.
John, thank you so much for being on This Week in Money.
Sure thing, Jim.
My guest has been John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Bob Hoye, John Rubino, and thank you for listening. If you have any questions for our guests, you can send them to info@howestreet.com. Now stand by for company showcase updates from American Manganese CEO Larry Reaugh and Aven Resources President Jim Pettit. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry.
Well, Jim, great to be here.
Larry, you brought out a news release at the start of the week. What was in it?
Well, we were talking about Stage 5, and people were waiting on that one. We did announce that we successfully completed that final Stage 5, which will open the door to writing up a new patent. But we were unable to put a lot of details into it, and I just would like to explain why that happened. There's certain things in there that you'd talk about that would tip off our competitors to exactly what we're doing. So we decided to, be a little bit cautious on what we said about that patent. Is all we can really say is that it was successful, and we will be applying for a patent. But when it comes to patenting something, you don't want to tip your hand to what it's going to be, because you might have somebody else that's working on the same scenario, and they may jump the gun and beat you, because it's been my opinion for years that when somebody has an idea about something, there's another 100 guys out there that have the same idea at the same time, but you're lucky if 2 or 3% of it act on it. But we're real happy with that result, and we hope to be able to start working on third-party submissions. We've got some EV battery companies that have material in front of us. We've got material from the Department of Energy. We've got material from our MOU partner in the Netherlands. It all has to be done. And we're looking forward to getting a good start on that. So, and we basically received pretty much, I think, every bit of material that was promised to us as late as yesterday. So we're ready to move on that. But looking at the overall picture, people may have noticed that the battery manufacturing section has slowed down, which is to be expected during this trade war. And so the demand for EV batteries has slowed down. I don't think that's anything permanent. I think that will snap back very quickly. And but it does affect the general overall market. So we're not concerned about that. We think that there's going to be batteries reaching the end of the life regardless, and so the China has taken away some of the incentives for making EV cars, which is a big effect on battery manufacturing and EV manufacturing, because they manufacture 50% of all the material. India, that's been moving ahead at a fast rate to incorporate manufacturing of batteries, the building of EV cars, and of course recycling. So, and things have slowed down a little bit there, but I don't expect that to be a permanent situation. All in all, I'd say we're in really good shape for the upcoming onslaught of batteries that will become available in the next year to 2 years, and certainly there's enough to keep us busy now. So we have to get a plant built and get that commercialization out or the demonstration commercial plant, which would be about 3 tons, started early in the new year. And we also want to start working on the estimates for building the plant and the production that will be taken from the plant and the profitability of the plant and, of course, the drawings. So that's the next big step for the company. I'm looking forward to getting that started. The general overall markets have been up and down, up and down. We're doing well today. But the overall markets have, any little bit of news about the trade wars or China and the U.S., and it's up or it's down, it's sideways. And then when you stop and look at it, the Dow is still trading pretty close to its all-time highs, within a couple of hundred points. So that's encouraging, if anything should be. The markets are, of course, very important to what every company out there does that has to raise money. We need good markets. It's very difficult to raise money in bad markets. And so, we're rooting, of course, for good markets. And I foresee that the markets will get better. I think that a lot of people are nervous about October coming up, but there's always a month that everybody gets nervous in. But I don't think we're going to have a repeat of 2008. So this is a good time to realign ourselves and move ahead with our project. And I'm hoping that everybody's satisfied with the fact that we're one of the few, or pretty close to the only company out there that has patented a process in a very short period of time. And one thing that I would remind people of, you have to focus. I've got a shareholder that's wanting to know if I'm going to be looking at rare earths or any other technologies. The answer at this time is that we have to remain focused on what we're stick to our knitting, you might say. And because that's what makes projects work. If you lose your focus, the project falls apart. So, and it's been a lot of tedious work up to this point, and I'm only too happy to continue with that tedious work to see the success of this company down the road.
Larry, for people new to American Manganese, can you maybe explain what the company's all about?
American Manganese is a critical metals company. It's a mining company, and that has patents for treating low grades of manganese. And recognizing back a few years ago in 2015 when the idea hit that maybe this would work for lithium-ion battery cathode materials, we started on that in 2016, and every step we've taken forward has been positive. And we now have 2 patents and a third one going to be applied for. And that's for recycling, of course. And the company trades on the Toronto Venture Exchange under the symbol AMY. It trades in the U.S. under the symbol AMYZF. And it trades on the Frankfurt market under the symbol 2AM. And you can phone us at 778-574-4444, or you can send me an email at lreaugh@amymn.com. And or go to our website. There's all the due diligence you need to do on the company is on our website, AmericanManganeseInc.com. And I wish everybody a great weekend.
Larry, thanks a lot for the update.
You're welcome.
We've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on September 20th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. I'm speaking with Jim Pettit, CEO and President of Aven Resources. Welcome back to the show, Jim.
Thank you very much, Jim.
Jim, Aben just put out a news release. What's in it?
Well, there's more holes, another 5 holes, which puts us up to 8 now, reported on the season. I think we're probably at about 20, we'll probably finish at around 24 or 25 holes. So we've got lots more. And these holes were all drilled about 300 to 500 meters south of the north boundary zone where we hit all the high grade the last few years. We're moving south of it and working with our geophysical information overlaid with the geochem and testing some of these anomalies that we're seeing in the geophysics and moving south. I mean, starting at about 300 meters south of north boundary is the Noranda hole. So we've done more holes around there. These are now reported. There's a bit of, a little bit of excitement, in a couple of the holes. We've hit some higher grades, but, still looking a little bit discontinuous. So what we want to do is basically follow these, what we see in the geophysics, and the geochem in terms of alteration. And if we have, we're in quartz cerussite now in that whole area as we head south and, starting to move into what's called a potassic environment, which means we're getting closer to a heat source. And as we do that's giving us an indication that we're getting closer to possibly a source for all the gold in that area. Because every hole we hit is high grade, or not high grade, sorry, but mineralized. We'd like to be able to find some continuity. And once we understand the structure and where it's coming from, we'll be able to drill with more confidence. And that's what we're at right now. That's kind of why it's called exploration. And now we're down even further south by the south boundary zone, and actually we'll finish up the season 12 kilometers further south on the Forrest property. We still have some 3-4 holes that we're going to drill down there, where that big intrusive is that sticks out, and it's got really good gold samples around the north flank of it. We're going to test that. That'll put us over the top as far as our total earn-in for the option for the whole package of land we have there. So after that drilling's done, we will now have 100% of everything. And, that's a good feeling. But this is a really good exploration program we're into right now.
Where does Aben go from here?
Well, let's say we get through the season, I think there's going to be more excitement. We didn't hit the high grade at the beginning of the season, so the market sold off on that because the last 2 years we did. We have a lot of holes to go, to report on, and there's lots of potential for excitement. One of the things I now know is we can't rush any more assays. The lab won't allow any more rushed assays because there's so much, in the lab, that they're just getting backed up, so they don't want to take rush assays. So we got to wait. And I think there's going to be more excitement to come. And there's probably reporting going through to probably the end of October, maybe into November. So there's plenty of time.
For people who are new to Aven Resources, what's the company all about?
We're into gold. That's what we do. Exploration for gold. We've got the Justin property in the Yukon. And the Hit actually, and the Forrest Kerr projects here. And I'm going to possibly look at the Chico project in Saskatchewan. That's, I'm asked by the community there to come back because we did start something and the community didn't want us there, but apparently they do now. We'll have a look at that, but there's other things I'm looking at in the future, so possibly we get a year-round program going, as well as what we're doing up here in the winter.
Where is Aben traded and under what symbols?
Symbol in Canada, it's the TSX Venture, it's ABN. Down in the States on the OTC, it's ABN AF. And if people wanted more information about Aben, where should they go? You can go to avenresources.com. It's the easiest way to. It's a great website.
Jim, has there been a lot of buzz about the company this year that you didn't expect?
There has been. There's been, it's always the anticipation going into the season because we've had two early successes in the last 2 years. But there's a buzz. There's always a following. The stock pulled back and it's got a really solid base here now. And I think gold, the price of gold, since May is up $300. That's falling off a little bit now, but it's made expectations a lot higher and has driven a lot more people to the website and asking for information.
Jim, thank you so much for the update.
Anytime. Thanks.
We've been speaking with Jim Pettit, CEO and President of Aven Resources. I'm Jim Goddard. Our conversation took place on September 19th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at howstreet.com. Company Showcase is a production of Howe Street Media Incorporated.